You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW
Hello, welcome to the Investor Way with me, Sam Ball. It's the 12th of February 2025, and I'm rejoined by James, who uses the handle at Quality Compound on Twitter. He was on previously a few years ago. For anyone who's not listened to the original or wants to go over it, I am going to post James's original interview prior to this episode so that we don't need to go over the same stuff. And then this episode is just going to be a catch up on his portfolio, how it's done since, what's changed, and all that stuff. So, James, firstly, thank you very much for coming back on the show.
Hey Sam, brilliant to be back. Thanks for having me again.
Do you want to tell us what's been happening with your portfolio?
Wow, it seems like a while ago, doesn't it? So I think the as a top line in 2021, we obviously had a bit of a market wobble in 2022 that you know everyone probably went through that's listening to the podcast. But I suppose from a personal standpoint, from now until then, I've kind of made some changes in weighting and also some changes in kind of direction of where I wanted the portfolio to go, but also, a lifestyle event. As I was talking to you earlier, I bought myself a house, and I'm currently refurbishing that house. So, unfortunately, a chunk of the portfolio went towards that purchase, and so, naturally, you have to liquidate some funds to facilitate that. So I think that's quite an interesting process that we can obviously talk about. But I've definitely found from taking maybe 30% of the capital out of the portfolio, it really does make you think about what your portfolio is for and those life events that you go through as to what you want out of your portfolio over the next 10, 20, 30 years. And so I think during that process, that's where the most significant change has happened. And for me, it was kind of forcing me to really look at it and go, okay, what do I need to get rid of here? In terms of Peter Lynch, it's, pulling the weeds and watering the flowers is what you want to do. So a lot of that's happened, and we can talk about where the concentration's gone, I suppose, as we go along in this interview.
Would you be able to just expand on pulling the weeds? I'm assuming then when you've liquidated that third, you have got rid of the underperformers. Is there a sort of a theme to the stocks in the portfolio that were sold?
Yeah, well, we could probably pull up on Twitter or an old post of my old portfolio, and you would look at probably between 20 to 25 names, and I think we're now at under 11, so maybe 10 or nine names that are really kind of core holdings. So I think to answer your question, really that process is conviction related as opposed to necessarily performance related. So I think some of the holdings that kind of exited, maybe they'd even performed well, but the conviction wasn't there to kind of hold on to them for the next period of time. Because I think the way I've looked at it structurally is okay, this event that I'm going to have where I'm taking 30% of the capital out is probably going to be the biggest event now to impact the portfolio until maybe 10, 15, 20 years time. So there's going to be a long period of time now where I'm going to hold on to things and let them run, as opposed to seeing these events happen coming up a lot in the future. So I think that's kind of made me think a bit more about the next decade in terms of what each individual holding is going to be able to deliver. So I think talking specific, some of the things that kind of came out of the portfolio, a lot of the UK names came out of the portfolio. I think I've been trimming UK exposure pretty much since 2022 and kind of holding on to US names, which has worked out quite well, not just through the appreciation of the dollar, but also the US kind of index relative to the UK. So things that I sold, you could see JD Sports was one of the things that I was talking about probably in 2021 as being a good company to own, and a stock, and parting ways from that's been quite difficult because I still like the story. So that, for instance, some kind of of the consumer names that I also had. So Estee Lauder, PayPal I sold as well. So PayPal you could sort of say was on a quite a strong recovery trajectory when I made the decision to exit it. But when you look at the next decade, that's a stock that's quite difficult to have conviction in. So some of the trades occurred on that kind of basis.
Could you expand a bit more on, because one of the questions I was going to ask actually was there were a lot less or a lot fewer UK names in the portfolio. Has that just come about on a stock by stock basis where the ones you had less conviction in just happened to be the UK holdings?
Yeah, I think yes and no. I think I currently do a bit of writing for a newsletter for the Armchair Trader, which I was still doing, I think, when I last spoke to you. But I wrote a piece there recently that when you actually look at the outflows from the UK equity market, your outflows are it's a leaking bucket, which has shown very little sign of changing despite what the kind of the governments decide to do to kind of prop up the equity market. And not only are you getting kind of capital outflows from active funds, you're also getting no resurgence of capital where no one's deciding to list in the UK. Existing listings are moving their primary listing to New York or the NASDAQ. And essentially that's just creating a real downward pressure in the UK equity market. Funds, active managers are sort of shutting down funds. And so it's an increasingly pessimistic space to be a long-term holder of UK equities just when you've got a lack of buyers out there for it. The active managers are shutting down and they're facing redemptions on a monthly basis. Who's going to buy the mid to large cap UK equities that you think are undervalued? And someone needs to be actively buying them to drive the price up. So short of acquirers and private equity getting involved, you just have this risk of something languishing. So that's the kind of the overall backdrop. But then I think on an individual basis, I've just been seeing more and more how disappointing the kind of the performance of the actual business of a UK kind of UK PLC, how they conduct business and the returns that they seem to be getting, revenue growth over consistent periods. When you contrast that to their US peers, who has the answer for it? But it's disappointing. To come back to JD, it's got a very similar peer in the US called Dick's Sporting Goods. They sell the same product. They have the same suppliers. They're in very, very similar categories. Dick's sells a bit more kind of sporting goods like baseball bats and football padding than JD does, but very similar categories. And I think Dick's has done something like 400% in 5 years, and JD's either flat or negative. And you actually look at the organic rates of growth of these businesses, and it is reflected that Dick's is growing faster. It's hard to sort of say what the core reason is there, but it seems to be reflected not just across one industry. I look at a business called Ashted in the UK, which is it's a fantastic business. They've got almost 90% of the company, the operations are in the US. It's called Sunbelt Rentals is their operating company in the US. And so all of the revenue and growth should reflect what a US peer performs like. But take a look at United Rentals, the US based rental equipment provider. It trounces Ashted on a sort of a 5 year, 1 year, whatever kind of short to medium term share price outlook. And it's not just in multiple growth, it's in the underlying performance of the business. So it's quite hard to get to the crux of what's driving the difference in operational performance between a company being based in the UK and the US. Maybe it's the talent, maybe it's the remuneration policy, maybe it's just the mindset of kind of going for growth and that ambition that American corporates have. I don't know, maybe you've got an insight, but that's been it's been company based, but also this kind of growing systemic backdrop to UK equities that has kind of driven the shift.
What's the website for the armchair trader? Is it just thearmchairtrader.com?
Thearmchairtrader.com.
And you've got a blog on it.
Exactly, yeah.
So it's like Substack.
Well, somewhat. It's a financial publication, so they've got a list of writers that obviously write for them, and the guys that run it obviously write it too.
Ah.
So I was doing kind of some of their publications for the core website, but I'm now running a tips column that you can click on. It's on their kind of main dashboard.
Oh,
And
are you the only one doing the tips, or is there a few
no, there's
others?
there's three of us that are currently writing them.
FTSE 350 share tips.
Yep, and then a US stock tips as well. It
Oh, I
is
can't, I've got to sign up for the full
it, it,
story.
it is sadly behind a paywall, some of it,
Oh,
but it's a very good website for kind of the generalist information. So you can subscribe to their email prompt and you get the updates for the day. Is quite a good tool.
is there any point signing up for FTSE 350 tips from a man who's so bearish on the FTSE in the UK in general?
Maybe,
Um,
maybe not, but I try
so,
and find the diamond in the rough, so to speak.
so if we go back to Ashted, then we
Yeah.
covered it on the show fairly recently, and they're moving their listing to the US, and they kind of made the comments that it's kind of a cosmetic change. It reflects, as you've said, the fact that most of the business is done there anyway, management are based there. Or I'd kind of looked at that and thought that was just a cosmetic change and couldn't really see it making much of a difference to the business. I did think the multiple might go up a bit being listed in the US, but would you then be more bullish that that change would actually help drive the business forward if you think there's more of a fundamental problem with actually running a business from the UK?
Yeah, I think there are remuneration policies that change when you're a listed business in the US or your primary listing is there. I'm not kind of into the details of it, but I understand that maybe it's more, you're going to have to pay a more competitive rate. Maybe there's kind of other kind of legal changes that you can enact by being a US kind of listed company. So it's I suppose a bit of a grey area, but I would suppose you'd get benefit, and also from the multiple appreciation. If you're going and acquiring other smaller businesses at a higher multiple, probably going to do better off from that when you issue your options.
Obviously, the multiples are a lot lower in the UK, and I'd have argued that's probably a better thing for a long-term investor because yes, you're not getting that multiple expansion you maybe get in the US if a business performs, but if you have a business that is performing well, the amount of earnings it will generate for you each year compared to what you've paid is just lower in the UK. I think you're the first person I've spoken to on the show that has actually made an argument that being a business being run from the UK for whatever reason seems to make it worse than if it's run in the US. I think I've had people come on and say, well, there's higher quality companies in the US and it's obviously got the tech sector and everything else. But I'd never really thought about, is there something about the UK that's actually resulting in not just the multiples being lower, but the businesses themselves being worse? I do find it interesting.
Yeah, I mean, if you look at productivity, if you look at, I need to look again at this, but as I understood it, the statutory working holiday period in the US is a lot lower than the UK. I think it's 10 days.
Yeah, I think it
Um,
is.
you might correct me, but
2 weeks.
we've got some American friends, and I've kind of met them, as kids, and then a couple they're based in Carolina and were based in New York quite a few years ago, but we met them a couple of months ago, about 6 months ago, and as an older adult, I kind of realized that being part of the kind of adult conversations, the psyche of this American couple is completely different to the psyche of a UK couple. The kind of the capitalistic structure and psyche is so ingrained. The household allocation of equity ownership from the stock market there is triple what we have in the UK. Just the need to earn to survive is so much more out there. And so I think everyone's minds are geared towards growth and earnings and earning as much as you can in order to look after yourself and your family. And I think that here we're much more sanguine about kind of getting to a certain level and you're comfortable with that. So I just think it's the growth mindset out there, which I'd personally rather live somewhere that isn't so aggressive in terms of always needing money and the relentless pursuit of growth and materialism as a personal thing. But I think it does have an impact on business performance.
Can we talk about then one of the few, I don't know if there are any others actually. So there's a couple of, so Games Workshop is listed in the UK. I think ASML's Dutch, isn't it? I
Yeah.
don't know Tempest, Halo, and Halo's I'm. Are either of those in the UK?
No,
So
no, they're
is
both
Games Workshop
US.
the only UK stock remaining then?
Correct.
Why did you decide to keep it? And what's
Um,
different about it?
yeah, I do really like the business. I think what you've just said, what's different about it is probably the most interesting thing because it's so different. I think I was thinking about this, and I think what what is so essential with Games Workshop is it's sometimes when you think about analyzing a stock and you think, wow, something has a great product, and you spend a lot of time thinking about how great a product or service is, and you don't think about how great the customer is. And what Games Workshop is, to me, it has a fantastic customer, and that customer is in the perfect category of being typically a high median income. They typically come into the product at two different stages. They come in at the like very young, and then they come in at the kind of maybe 30s or plus when they have a life event or they have a bit more time on their hands, after university or whatever. They kind of come back to the product in these two different stages. And both stages, when you're a child, you've got masses of disposable income because you're not paying for anything. And then obviously in that later period, the types of customer have a good disposable income. So there's the customer loyalty and the profile of the customer that makes Games Workshop special, on top of obviously the very unique product, the fantastically run business, the fact it doesn't operate on like a quarterly schedule, it barely says anything to analysts. I found out the other day that the CEO Roundtree, he doesn't even have a public image of himself available on the internet. That's how little he's bothered with being seen and being glossed up on a front page about being a CEO. He's just interested in running the business. So I think that is really special. And I think when you look at other businesses that have specific kind of core customers that they know very well and have good median incomes, and that cycle can kind of support the business, those sorts of businesses do very well. So it's that kind of marrying of product and service and customer. And obviously you've got these growth drivers that could come in. So even though the business is pretty good at generating cash flow and pays a nice dividend and can do a steady performance in any given year with just the miniatures, that IP technology licensing side of the business where you've got the ability to earn maybe 30 million in a year, maybe more with the Amazon deal coming in royalties that are pretty much dropping through to the bottom line. That's really attractive. So when you're trying to construct a portfolio, getting some stocks in there that can be a little bit different and have different sources of income to the other ones, if you're kind of going through the long haul, it's a good thing to have some of that differentiation. And I think that's where it got over the bar, so to speak, to remain within the portfolio.
Were there any others that were close to remaining in the UK, or was it just the best by a distance?
There would have been other things that would be in the portfolio or be bought, at the right price. But we were talking a bit pessimistically about the UK earlier, but I think the UK does have really good companies, and there are some that are definitely worth buying. But I suppose because the UK has so few good listed companies, that you end up with the really good ones being priced quite highly, and therefore they become difficult to access. If you look through the FTSE 100 at some of the top performing companies over a given period of time, you could probably run a screen, but something like over the last 5 years, something like Experian might pop up. I'll try and rack my brains for other examples, but if you look at Experian, I don't think that necessarily on a massively cheap valuation compared to what's available in the US, which is Equifax or FICO or something like that. I don't think the gap is huge. So with Games Workshop, where I suppose people fear that the company's not going to kind of go the long haul, or maybe they're not bought into the idea that kind of miniature figurines could be a sustainable business, or that they thought that their customer group would disband and start 3D printing the models and things like that. So I think there were quite a few pessimistic or kind of bear cases that were driving the Games Workshop price to not be fairly valued or a little bit undervalued compared to what you think would be a fair price to pay for such a good business. So I think there are some other things that I probably would have in there, but it's just a price and timing piece.
I might be misremembering, but did you have previously have Fever Tree and Gamma Communications in the portfolio?
Yes, yeah, I did.
I don't know why I remember that. It's probably because I used to own Gamma myself and now own Fever Tree. So what were the decisions for selling those two?
They're both quite interesting businesses. I think Gamma, I was trading a little bit, so hopping in and out of, and I do like that as a business. It just, when you look at the growth rates available from some of the US businesses, it's hard to justify just sitting your money in a fairly pedestrian business, albeit probably can do high single digit growth in most years, and maybe a couple of years it can do double digits. It just wasn't attractive enough when you're running a concentrated portfolio to kind of keep that holding running. And I think you kind of just got to make those tough decisions. So good company, but not growing fast enough for me. The Fever Tree situation, I think Fever Tree has just been a bit of a disappointment in terms of it has a very good brand. It's got a fantastic opportunity sitting in front of it. I think if you were management maybe 3, 4 years ago, what you would have done is when you were launching in America, maybe do a capital raise a decent amount, which would have put pain on the shares in the short term, but you could have grown that brand presence a little bit faster. You've seen how some of the US consumer companies, are thinking like Celsius drinks and things like that, they do marketing in such a way that just creates a tailwind for the company. And I just think Fever Tree has missed a little bit of an opportunity to really step on the gas with the US launch. And you had all of the problems a couple of years ago, I think, whether it was 2021 or 22, where glass price inflation was huge. So you've got Fever Tree sending glass bottles from the UK to America in a container ship. And by the time that the glass bottles have arrived in America, you're not making much money. And so, just as a business, it's one of those kind of UK businesses that is stuck between a bit of a rock and a hard place where I think it's afraid or can't raise capital to go and do the job that it needs to do. So it ends up just doing a bit of a half baked launch and rollout in America and not really gaining the momentum that it should be. You're obviously holding it, so I might be wrong.
Did the cause deal make any difference to you?
That was recent, wasn't it?
That was, I think it's a couple of weeks ago, 2 or 3 weeks ago, something like
Yeah.
that from memory.
Do you know what? It popped up on my feed and I glossed over it. I don't know the essence of the deal. Is it a distribution partner?
Yeah, so they've sold. I'm making up a number now, but they've sold
Yeah.
something like 8 to 10% of the business to cause,
Mm.
so that cause have enough of an interest to actually be bothered about how Fevertree does. They're using the funds. I think they said they're going to be upping marketing significantly, but then most of those actual funds from the equity raise are just going to be used to buy back shares so that the shareholders aren't diluted as much. And then they're going to be using sort of causes, contacts, and distribution and stuff like that, and
Mm.
marketing know-how. So on the surface, I'd only bought, I want to say I bought around October, November 2024. And then I was probably about break even when the cause deal was announced. And then I think it gained like 15% on the day. And I think it's since given most of it back. But my view was I was very happy with it. I would have been quite happy at the price I'd bought it at if Fevertree had just kind of grown sort of 10% a year, because they're now at the point where the US business is actually larger than the UK and it's still growing at a decent rate. So although the UK is now slightly declining, I think that's probably just it's going to rise and fall kind of with the tonic market in the UK, and
Yeah.
it's pretty saturated at this point. Whereas in the US, I think it has the opportunity for double-digit growth to continue for a long time, even without the cause deal. I think it was still growing at a fairly decent rate. So yes, I thought that was very good news. I was very happy because obviously it was just quite a nice surprise for me in terms of the timing.
Yeah, I was quite interested that would you say if you looked at the chart that Fever Tree's at all-time lows at the moment, or kind of just a bit off the bottom,
Yeah, it's
or
pretty
52 week?
something like that. So it's at around £7 a share. I think it's probably been as low as six. Yeah,
So
so it's £7.14 a share. So it's a 52-week low is £6 and 8p. So it's pretty close. But then obviously if you go back a few years and it was at £27 a share, £30
yeah,
a share, whatever it
yeah.
was.
So I can't understand why hasn't a PepsiCo swept in and bought it?
It's a good question. I don't know. I don't know if it was partly a price. The thing is, it's come down so much, but it has come from because it was always 50 times earnings for
Yeah.
years. And now I think it's at something like 20 times earnings, but it's 20 times reduced earnings. But yeah, I don't really get why, like you say, a PepsiCo or a Diageo or someone else hasn't just gone in and tried to buy, or even Coors. I don't know why Coors didn't just go in and try and buy the lot, but
So this is a good example of what I was saying earlier that I think it's a good business. I think it's an attractive price. It's clearly got opportunities ahead of it, but who's going to buy the stock to give it that re-rating if there's no active managers out there and there's outflows? That's the problem.
but do you need a re-rating? If Coors come in and actually do a decent job with the distribution, if the US is growing double digits every year, you'd get it from the earnings growth. So multiple expansion. If it was to go back from 20 to 50 times earnings and the earnings were to recover to what they previously were, it'd be nice to have the multiple expansion as well. But I just think with Fever Tree, it's at such a low price that you can do, especially if you look at, I appreciate what you were saying about the glass cost, but if you take like, I can't remember which one it is, but the last good year they had before the glass cost went up, so like 2020 or something, if you treat those as the normalized earnings, it's incredibly cheap.
Yeah.
And I just think, well, it's kind of at a price where you don't need the multiple to re-rate to do really well off it if the business can grow double digits every year. And I think with the US sort of still being hopefully in its infancy, I think it's got a pretty good chance of doing that.
Well, that's interesting. I'll have to revisit it.
It was quite interesting as well because obviously we did it on the show, but when the cause deal was announced, I thought it seemed like a very, very positive step. And if you kind of look at the share price in the last month, it spiked massively on the day. So it went from like £6.58 up to £8, and it's already given a lot of it back, which I do just find a bit odd. But so it's not actually that different a share price to kind of what it was before the cause deal was announced. So
Did Cause take 8% equity of the US business or just
I think it's of the lot, is my
right?
memory. Just one sec, I'll see if I can. Yes, it was the 30th of Jan. Strategic partnership. They bought an 8.5% stake in Fever Tree, is how it's worded in this article. Say somewhere in the article, but basically they're going to be ramping up the marketing spend as well. So
That's good to
yeah,
know.
right. So anyway, back to your portfolio, not mine. You've got Samd Group at 0%. Why is that on the list? Has it just been sold and it's not been deleted from a spreadsheet or something?
That was a 2020, 2021 blow up, shall we call it? So it's Samarkand Group that I think the valuation now is so low it doesn't even justify a percentage on the card. So
Is it in an
um,
ISA?
it's in an ISA, yeah,
Oh dear.
yeah. So unfortunately, there's not a lot I can do about that. And I leave it there for the reason that I think if I was to liquidate the position, I'd probably receive about £10. But I think it's a better warning to myself to not buy unquoted companies on the equity stock exchange. So lesson learned with that one.
So what actually went wrong with it?
To be honest, I think the company is it's an interesting company. It's basically a sales and distribution portal to China. So for companies like, let's say, L'Oreal want to market a new lip gloss in province of China, this company, Samarkand Group, can kind of take their product and use all of their internal knowledge in terms of all of the Chinese, not only kind of marketing platforms, the kind of things like Weibo, WeChat, Bilibili, which is I think the TikTok of China. So all of those platforms that they use, but also combined with the kind of Chinese regulatory network that they have access to. So that was the pitch, that companies would be able to use them as a kind of turnkey solution to kind of accessing that market. And I think when I bought it, the company was doing growth rates of about 100%, and they were scaling up both their own owned products. I think they've got kind of a handful of beauty and skincare kind of treatments that they were selling on their platforms, but they were also doing third party. So it was almost like the THG ingenuity of China based in the UK. But I think it's kind of unwound a bit, where their third party transactions that they were doing, they weren't making enough margin on the distribution. And so they kind of wound that arm down, which meant all the revenue growth evaporated, and they were kind of relying on their own branded goods to sell into China. And as we know from the experience of Estee Lauder and L'Oreal, China's not been a very pleasant place to sell your expensive branded skincare items from 2021 onwards, really. So I think that's kind of caused the overall destruction of the business, and now it's valued at about 99% less than what it was worth. Good thing that it was only a very slim speculative part of the portfolio. But
So if we move on to Axon Enterprise, so I think you held this last time anyway, but I don't remember it being as big. So it's
yeah,
almost a quarter of the portfolio. Why do you like it that much? And how do you feel about having it that concentrated?
so it's done a lot of the work itself. So I think it was the top performer in the S&P 500 last year. It actually, as a kind of a journey, I suppose, as a company, it's really kind of come on leaps and bounds since that 2020 kind of 21 period that we were talking about it. And so it was included into the S&P 500, I think, in 2024, and it's had a very good year. So I think over the last maybe 5 or so years of owning it, it's up over 600%. So a lot of that concentration has been its own doing, and I just think it's too good a business to touch at all. So I've just let the holding run, and I think in terms of conviction, it's up there with the number one stock that I see in the market as something that's going to be growing for multiple years to come. So I can kind of expand on the story of Axon if you want me to.
Yeah, go for it.
Yeah, so I suppose to people who haven't been really introduced to Axon Enterprises as a company, this is a company that used to be called Taser International, and in 27 it changed its name to Axon Enterprise. So it used to be, well, it still is the producer of the Taser electrical kind of defense weapon that's been kind of brought in and rolled out throughout the US and the UK and other markets across the globe. And so obviously Taser was a revolutionary product that is aimed at reducing the amount of deaths from guns primarily used by police forces across the world. So that Taser product, what they do is essentially every year or every couple of years, they update the Taser hardware to include new features and something that either kind of gets better in terms of its use or more nodules to fire the Taser out of and improve that service. So that Taser's constantly improving. And then they brought out the body cameras. So if you walk down the streets of London and you go past a police officer, you'll probably see they're wearing a body cam. And for the case of the Met, they're all using the Axon body cams, as pretty much 90% of the police force in the US uses the Axon body cam as well. And so this is just a revolution to be able to film and capture what's going on from the police officer's point of view, and is just essential in being able to kind of be relied upon as evidence in court. And if there's any disputes, that's essential too. And if we go back in time to maybe a couple of years into owning it, it only strengthened my conviction when you see events such as George Floyd in America and other things happening. When stuff like that happens and it's captured on an Axon body camera, the world starts to see the value of having this sort of footage recorded. Whatever your opinion is on those sorts of events, it's kind of transformed the need for having that footage, both for the police officer's safety and the safety of the general public when this sort of stuff's happening. So the body cameras was like stage 2 for Axon. And then, of course, they have developed their cloud-based system that links the hardware together. And this really just kind of fortifies what you would call a moat for the business, where it's now linking that hardware in with an ecosystem. And so the cloud software can capture all of the data from the camera footage. It can also capture the data from the taser. So as soon as the Axon system recognizes the taser's been taken out of the holster by a police officer, it will ping that location into the cloud, and it'll start recording from the camera, and it'll give that geolocational time and space data to the evidence system. So whenever the kind of report is filed to court, you'll be able to kind of see all of this evidence in a really kind of easy workflow to review. So that was kind of stage 3 with the cloud. And then what they've been doing is adding either extra software capabilities to the cloud. So we all in kind of the corporate world work on Microsoft Teams and use various kind of software applications. But as a police officer, Axon makes a specialized workflow for a police officer. So if you're out giving someone a parking ticket or fine for whatever criminal activity, you can write up the report in the Axon workflow, and that gets recorded into a profile. So it's essentially almost a CRM for law enforcement. And so this all creates a great big ecosystem that you can then plug more hardware into. And I think their latest venture is drone evidence capture. So if there's a criminal offense taking place somewhere, they can send the drone out as the first responder, and that can start filming and taking recording data into the cloud. So it's that flywheel effect that constantly kind of grows and gets bigger and fortifies the moat for the company. And pretty much the whole time I've been holding Axon, there's no way that you can value the company on any kind of reasonable basis, but to kind of look at the company and go, okay, when I bought it, the valuation was 7 billion. Can this company foreseeably get to 70 billion in terms of what it's able to achieve and what the total addressable market is and the hardware and software? And well, lo and behold, we're now at about 50 billion. So we're nearly there in terms of that tenfold. And I think as you look at the business today, does it have the ability to do another 10x and go to 500 billion? Probably the answer is yes. And so that's my kind of way of working the thinking around Axon. It's kind of a strange place to get to where you're not really operating in the kind of sane, reasonable world of PE valuation analysis. It's more on a kind of, don't know what you could call it, but it's the growth kind of basis, and you probably look at the price to sales and things like that. But so yeah, I'm incredibly interested in the company. I think what maybe the stretch that we're going into now that has changed for Axon that I think people need to be aware of before opening a position is the fact that for the first time we're starting to see competition coming into Axon's market. So the kind of the world of justice and police force software and hardware like this was pretty much an open door for Axon to push into. But we've noticed, over a couple of years, there are some competitive entrants. One is a company called Cellbrite. It's spelled Celle, Bright, and it's an Israeli company that started off doing hacking of criminal phones on a kind of a sanctioned basis in the US and Israel. And so essentially, if you were a police force and you wanted to get a criminal's data from their phone, you can use the software that this company provides. But essentially, I think where Cellbrite have seen that Axon's making a lot of money in these adjacent areas, they've started to grow and scale their business and become a real competitor. So they're starting to kind of bring out some of these cloud services that Axon is, a market leader in. And so we're yet to see whether Axon could kind of really take on a competitor with a lot of fortitude. But I think it'll probably be a positive.
So, seeing as we're speaking about Axon, and you basically said your valuation base is can it 10x from here? And the answer is still yes. Another expensive US company that you hold is Microsoft. Can you talk about why you like that and also how you feel about the valuation? Because I appreciate it does actually have a more reasonable PE, but I think it's something like 30, and it's an unbelievably high quality business. But at a market cap of over 3 trillion, I'm assuming you don't see it 10xing.
No, probably not. I think it's Microsoft's probably the least desirable or attractive business that I've got in the portfolio. And it's one that I struggle to strike up a reason to sell, sadly. So I think I was much more excited about Microsoft 5 years ago than I probably am now. And I kind of view it almost as a bit of a, it's a tax on doing business. It's just a gargantuan company that, as you say, it's very well run and its margins are fantastic. So I think its operating margin is in the 40% kind of arena. So when you look at some of the businesses in the US that command a valuation of 50 times earnings, there is a lot out there that aren't as good as Microsoft or don't have the same growth and profitability metrics as Microsoft. So I don't necessarily think that its valuation is sky high. I think that its predictability brings such value as an investor, and its size is somewhat daunting when you start to think about where returns could go from here. But America is a place that I don't think puts any restriction on market cap. It's not a problem to be big in America. It's almost seen as a good thing. So I think whilst it's not the most attractive kind of opportunity and the valuation sort of fairly punchy but reasonable, you've also got Satya who doesn't seem to miss a kind of a global opportunity. They are straight in there when it comes to the secular trends. They didn't miss cloud, they've not missed AI. They're straight into kind of adopting whatever the kind of global scalable technology is at the time. And I think if you can rely on a company to do that, you can rely on Microsoft. So I think that's a good thing that they've kind of got those corners covered. And we haven't really talked about AI on the call yet, but I think even if you're skeptical of AI or maybe you're thinking that some of the companies within the AI sphere trade at insane valuations and they're very risky, Microsoft is still kind of a small way to play AI, but kind of get that exposure to what the potential outcomes might be, but also from a kind of a slightly de-risk kind of space.
I do love the phrase that Microsoft is a tax on doing business because I do think you've just sort of summed it up in a sentence, really, because you can't see a way you could feasibly run an office-based business without Microsoft. I think it is just like, if you think about what I do, it would just be absolutely impossible. Can we move on to ASML Holdings? So is that because that's a European company? So do you feel, firstly, more general question, do you feel the same way about European companies as you do compared to the US as you do with UK? And then secondly, if so, what makes ASML different?
Yeah, it's a good question. I probably feel Europe is more in a similar situation to the UK than it is closer to the US. It's a broad basket, so you've got more ability to find some of the kind of good companies out there. And I think Europe is littered with really good companies, lots of companies with like long-term family holdings and foundations. I really like Novo Nordisk, and there's good luxury businesses in Europe that aren't maybe attractive right now because of China, but do have the potential probably to go on and do good things. So I think it's a good place. I just think on the balance at the moment, the US is more attractive as a place to invest. When it comes to ASML, this is just a company that is probably the standout leader globally in providing the kind of the kit and the toolkit to go out and produce chips. I think it's an interesting company. It's probably one of the few companies in the world that has the highest kind of average selling price for its product. You're looking at maybe a $400 million transaction value for one machine, which kind of brings interesting dynamics, and you get this kind of lumpy order flow where the kind of the fabricators and the chip manufacturers are pensive on ordering new machines. And so you get these quarters. If you look at the chart, it's not very linear like a lot of the kind of the tech industry because of these kind of big order volumes. So I think that's kind of created an opportunity to buy the shares recently. I think what interests me into the company, again, it's probably a little bit like Axon. It's more the story where you have a company that is doing something that I don't think anyone else in the world can do in terms of its market share, but the specifics of what it does in lithography, printing, using these very, very complex lasers to lay onto chips. The refinement of what it does is, we're talking NASA scale refinement. This isn't anything that anyone could scale up without billions and billions of research, and then would probably need the IP to go along with it. So you're just looking at a highly defendable company in a great sector right now, which is obviously chip production and the tailwind from AI. So I think it's a timing piece that's allowed me to sort of enter a company like SML rather than necessarily the long kind of term, if you know what I mean.
How long would you see your timeline for that being then?
I think probably more a period of 3 to 5 years. I think where the chip market itself is quite it runs on a cycle. I think you could foreseeably see something where there's a kind of slowdown in orders that come, after this period of AI boom ends. So it'd be a company that I'm very happy to kind of hold on to whilst the segment is kind of growing and doing well. But I wouldn't sit on a company in the chip industry in a downswing. I wouldn't see the point of that.
Tempest AI, I'm presuming they do something to do with AI, but what is that and why do you like it? And also why have you kind of identified that as an opportunity? Because I imagine if you're looking for a stock that's going to give you exposure to AI, you've got to be careful of the amount of hype that there is probably in a lot of companies that will never actually deliver anything.
Yes, totally agreed. I think it's quite interesting on that. So with Tempest, I probably added this to portfolio a couple of months ago, and it's up 91% since then. So you're looking at a very volatile stock. I think about 4 or 5 days after I bought it, the US, I don't know whether she's the Speaker of the House or Nancy Pelosi, who seems to be a prolific day trader or options trader, bought a load of Tempest as well. So that kind of put a little spotlight on the stock from the kind of US financial community. I think it's potentially in maybe a bit of a bubble at the moment. So I have trimmed the position a little bit. But what does Tempest do? Is essentially Tempest is your AI play for the healthcare industry. So it's got a few different arms. The main arm is genetics. It's also got a data arm and then a kind of a personal medicine arm. So essentially, what you could foresee Tempest doing is having a kind of, what would you maybe call a data lake, or a vast database of outcome data layered with genetics data too. And so it's going to use AI to correlate outcomes and genetics, whether that's for companies looking to position clinical trials or for individuals looking to select the correct treatment for them. They can kind of upload their genetics to a portal, and then AI can kind of keep that data, and then if they get ill, select a treatment that is optimal for them. So it's really a play on precision medicine and AI. And I think where Tempus probably sticks out for me compared to all the other AI names at the moment is you're looking at a company that's already doing 1 billion in revenue. It's recently made an acquisition of a company called Ambry Genetic, which took its revenue from about $600 million to around, I think, between 1 billion and 1.1 billion this year. So it is already a significant earner. And I think it's going to go EBITDA positive this year, cash flow positive the year afterwards. So you're looking at a company that's serious about its intentions, already generating significant revenues, but has this huge total addressable market ahead of it, where every year thousands of patients are taking medications that are suboptimal for them. You might have, I'm not sure how much you or your listeners know about the drug market in total, but obviously the biggest kind of market space within the drug market is the oncology space. And that's where Tempus's focus is. But most times when we look at oncology drugs, if you've got a certain type of cancer that you're going through, an important thing for you is to respond to the treatment. Now, if you have certain genetic exposures or predispositions, you can look at two people and they've got completely different genetic backdrop, and a treatment the person on the left might respond to that treatment and the person on the right might not. And we can tell whether they're going to respond to that treatment prior to them having it through their gene expression. But often we don't, because we either can't afford to do the test, doctors don't want to do the test for various reasons, or there's just not the analytical power to go and do that. So Tempus is going to help with trying to make some of those decisions at scale in a market like the US that people spend significant amounts of money on drug care. So I think you're looking at a company that has the ability to tap into that. In terms of the moat that we kind of come back to, they've got the widest network of hospitals and data institutions in healthcare of any other company. So they've partnered with the key hospitals and cancer centers in the US. So they've got all of that data from those institutions, and then they let them use the outputs of that data to kind of accelerate their processes. So that's a significant kind of thing that stops other people coming in. I think something like 19 out of the top 20 pharma companies are engaging with Tempus already in setting up their clinical trials by using their data sets to kind of optimize their clinical trials and choose the right patients to go into the clinical trial to get the best response from the drug. So you're looking at a company that's kind of just getting its feelers and just tapping into the space of healthcare with that AI application, and it's doing very well at it and kind of constantly updating the market with new platforms and bits of data. So I think it's quite exciting. It's at a reasonably early stage in its growth. I think the valuation is about 10 billion. So to answer that question earlier, could you see this going on and being a 100 billion company? You know, absolutely. But you could also see a significant drop if the market situation changes and the company doesn't carry on growing in line with the expectations. So yeah, it's an interesting one though.
Couple of follow-on questions then. So firstly, to make sure I'm understanding it right, the AI thing, I'm explaining this like a 5-year-old. The AI thing that it's doing, it might get better and it might learn and they might improve it, but the product is already working, ready to go, and it's already doing 1 billion of sales a year.
Correct. Correct.
Okay, I didn't expect that. And then our second one is it looks like it's doubled in the last month. What's the reason for that?
So this is where it becomes really difficult to know what to do. And I think I've had this with another trade recently that I like the long-term story in, but it's exactly what I said to start with. You know, if you look at Twitter and type in the ticker, everyone's doing these memes about Nancy Pelosi buying the options, before I bought the stock, they released earnings. So I knew they've not gone to the market and updated with any new kind of earnings. It's literally a catalyst of this Pelosi lady buying it, but also they released a patient-based application that I suppose you can see value in, that you will now be able to enter your health records into their app called Olivia AI. And so from birth, you can have all of your doctor's records stored in one place. And this company can then provide you with all of your outcome data, what the suggestions are for your health. You think about the amount of people that live with chronic conditions. You could get a situation where once all that data is embedded within this AI kind of application, the options are kind of limitless in terms of the recommendations it can provide you, the calculations that it can provide you in terms of if you do X, it's going to extend your life by this amount of time. It's probably going to save you this money in Medicare bills or whatever. So I think it's quite powerful in terms of what the proposition is. So those two things, but in my mind, not enough to justify the rally that it's seen over the last few months. I think I'd wait for a pullback before adding.
Zoomed out a bit further. So it's doubled. It was more than doubled in the last month, and it's now back to where it was in November.
Mm.
So it's quite a roller coaster. So probably the final question, because with the portfolio being so much more concentrated now, we've probably done about 70 or 80% of it. So Halozyme Therapeutics, what's that, and why do you like that one?
Yeah, I like this one a lot. I think it's a really under the radar name that no one seems to really know about, or when you look at the various channels, and it doesn't look extremely expensive either, but essentially it's a pharmaceutical company that you could call it's essentially taking a ride on the backs of the innovation that's currently going on within the big pharma market. So one of the biggest spaces within the oncology cancer care is immunotherapy. And so some of the big kind of immunotherapies that have come to market are, you could call, there's a product called Keytruda, which is a Merck originated product. I think that was maybe a couple of years ago the kind of the biggest drug by revenue across the globe. You've also got a kind of a competitor called nivolumab, which is BMS, and that does sort of similar vast revenue numbers. And you've got many other types of immunotherapy or similar classes of drugs that battle cancer, that are these kind of new ways of treating. And so these kind of treatments have become incredibly popular, but when they get developed, they're all developed as an IV, so intravenous kind of administered solution, which obviously requires a patient to sit in a chair and maybe have that infusion along with the monitoring of that infusion. So it takes maybe 3-4 hours for that whole process of getting the patient into the hospital and getting out the other side. So it's a fairly arduous treatment process. And so what this company has done, that's Halozyme, is they've essentially developed what's called a subcut formulation. So it's where these new novel drugs that battle cancer can be formulated in an injected format. And so what the Halozyme formulation is it's an enzyme that allows the kind of disbursement of that active ingredient into the soft tissue. So you could jab it, not sure where, but it might be into the abdomen or the leg. And that kind of allows the treatment to disperse within the body. It's the only company, I think, in the West that does it. There is a company, I think, listed in Korea that's got their own sort of similar formulation. But put it this way, I think something like 30 out of the top bracket of pharma companies and formulations have partnered with them. And so they've got an ever-growing list of drugs that have started to use that subcut formulation. So the company profits from when someone chooses to prescribe these cancer drugs in their formulated pen. And so the company also sort of takes a royalty on the prescription that's kind of currently ongoing and is set to ongo. So there's a real benefit in terms of not just the product is a better product than what the current standard of care is, and you're kind of seeing lots of uptake and regulatory approval of these formulations, but also in terms of the companies that are selling these drugs as well, it allows them a little bit of extra time before they get loss of exclusivity on their patents. So it's good for the companies because essentially you might have had an approval for a medicine in its intravenous formulation that's going to expire on sort of the terms of the patent. And then you do your clinical trials and your studies and the whole development piece of this new way of administering it. And it gives you that bit of extension and the kind of the ability to have something different to what your generic competitors are going to offer the market. So the companies will actively promote this bolt-on product. So it's something that kind of works for everyone involved, and Halozyme obviously gets that royalty. So growth has been pretty good for the company and it's quite a profitable business. So I think the trend will only continue of adopting that formulation, and so the royalties should continue to mount with it.
So would you consider this then probably, I guess, lower risk? It's not like lower risk in terms of it's just got a product, it's already got an established product that's going to be a money maker for a while until the patent or whatever runs out, and it's only trading at 19, 20 times earnings. It doesn't seem as hugely risky when you've described it as it maybe does on the surface, if that makes sense.
Yeah, I don't definitely don't think it's like a risky company. I think that if you look at the margins that it's currently kind of achieving in 2024, the expectations were net sales of 1 billion and operating profits of 533 million. So you do a margin calculation on that, it's pretty profitable business, and the growth rates are pretty steady too.
Basically, I just saw therapeutics in the name and had a look at it, and I was like,
Mm.
oh, that seems very risky. But the issue is for me, anything to do with that industry just goes straight in the too hard pile anyway.
I think what's interesting about it is it's that you're not necessarily relying on the kind of the boom and bust cycle of each drug company goes through this process of the ups and downs of, oh, it has a great product, it's coming to near loss of exclusivity, everyone gets in a panic, and then they either acquire more products or the pipeline comes through. It is an up and down bit of a roller coaster. But with this, you're looking at a royalty driven sales model that's kind of just profiting off the back of the development of the kind of headline drugs. So I think it is a bit de-risked.
Just looking at the portfolio, I don't think there really are any apart from Sammed one where it's already happened. But if we go back to say Tempus AI, for example, that could be a 10x, but that is quite high risk. I appreciate, as you've said, it's already doing 1 billion of revenue a year. So at least the business probably isn't a zero. The worst you can do is overpay for it. But do you feel like your mentality towards these kind of businesses has changed at all as a result of having a more concentrated portfolio? Because if one of these weren't to succeed, it makes more of a difference when it's, I don't know, 10% of the portfolio compared to previously where it might have been 2%.
Yeah, I think back to what we were chatting about at the beginning, I think maybe it might be where the thinking around what I want the portfolio to achieve has changed a bit. Where I've got the house purchase out of the way over, I think, the period of 2022 to 2024, I was living in an apartment and I had an incredibly low cost of living. And so I have a very nice salary sacrifice pension scheme at work. And so I basically diverted a lot of my kind of disposable income to that in order to benefit from that. So I took my contributions from, I think, like 10% to about 30% of my income, and it just kind of racked up those contributions. And so I've kind of got my personal kind of pension to a place that I'm very, very comfortable with. So I've got the steady Eddie part of personal finance sorted. I think, having that bit sorted, having the house sorted, it's put me in a bit of more of a position where I'm kind of viewing the personal stocks and shares ISA as something that I can kind of take a bit more risk with. and hopefully reap the return, as we can't get complacent. And I think the market is riding very high at the moment. And I think anytime I come on and speak to you, it seems to be a market tops, as was 2020. You go into this with an awareness of what you're trying to achieve and the risk level that you're taking on. But I think when you look at what the kind of more steady growth companies are able to achieve, it's not life-changing returns. Whereas when you look at some of the growth companies, they do have the ability to kind of really significantly change your financial situation if you make the right calls. So
How's the pension invested then?
it was across two funds, but it was in the S&P 500, 50% allocation, and then it was in the HSBC Islamic Equity Index, which is quite an interesting vehicle because it's a vehicle that basically, where it's according to Sharia law, it takes a lot of the crap out of the index. So it becomes very overweight Mag 7, and it's still a kind of seen as a low cost vehicle. So I think the charge is only like 0.4% on some platforms, but you're getting kind of concentrated exposure to US tech. So that did very well. And so I think probably 6 months ago, I thought, oh, I'm going to dial down the risk a little bit. And so I've just plonked it all into the S&P 500.
So it's interesting you say that. So my brother recently set up his logged into the account for his workplace pension because he'd never done it before. And he's 5 years younger than me, so he's almost 25. He was of the mentality, well, at his age, there's no point being in the standard plan because it'll put you in stuff like bonds and cash that you don't really need at that age because you're not going to be drawing it for at least 30 years.
Yeah.
So you may as well be all in equities. And when he'd logged in to actually look at what was on offer, if you wanted a fund that was all equities, his particular workplace pension must have been with a provider that's not got very many attractive options.
Yeah.
So he chose a Sharia pension, a Sharia fund like you did, but he'd kind of done it just because it was the only thing he could buy that was 100% exposure to equities.
Yeah.
So that's all his pensions in at the minute. And I'd kind of just said, well, it's probably going to do better, but it's one of the things where it's probably not going to be at the current employer forever. At some point, he'll move and he can just pull it into a SIV. But actually, it maybe doesn't sound as terrible as I would have initially thought.
Well, if it's the Islamic Equity HSBC version, he'll have done very well.
I don't know how many there are, but
Yeah,
who knows? Maybe it's every pension provider must probably have one, but I'd never really thought of it that way. I just kind of thought, well, his preference was just buy an index fund, but that wasn't an option. So he'd kind of bought that as the next best thing, but it maybe isn't so terrible after all. So I think that's everything on my side. Thank you very much for coming back. I'm sure we'll have you back on again in the future at some point. If your concentration carries on going the way it is, you'll be back on to talk about your one shareholding, probably Axon. But yeah, thank you very much for coming back on. Where can people find you and follow you if they would like to learn a bit more about you?
On Twitter at Quality Compound. I'm sure I'll probably be tweeted out on the Investor Way, so you can have my handle there. So yeah, reach out, DM me if you have a question about any of the equities discussed. Happy to help, but great to chat to you.
Right. Thank you very much for your time.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.